Today's subject is an interesting one. How are mortgage loan officers paid? There's a lot of people that would like to know more about this. So we have to draw a dividing line between the way that things work today and in what I oftentimes refer to as the bad old days of mortgage lending, certainly bad for the consumer. Prior to the financial crisis and some of the regulations that followed, loan officers could receive variable compensation based on the terms of the loan. Well, what does that mean? That means that a loan officer could earn a higher commission by offering higher rates. If they were looking at a rate sheet, for instance, the loan officer could actually calculate how much additional income they could earn by charging you, the consumer, a higher rate. Not only that, there were bad terms, or at least bad terms for the consumer. Things like prepayment penalties, negative amortization features, short teaser rates on adjustable rate loans. Loan officers could earn additional income by throwing those bad terms into the deal. And if they could get the consumer to agree to those items, they could earn additional compensation on top of their normal commission rates. Well, how have things changed? It took some time after the dust settled, but various regulators came to the table and said, we cannot tolerate variable compensation on the basis of the terms of the loan. It should not be allowed for a loan officer to earn more money, giving the consumer a worse deal. It's a huge conflict of interest, and it's not good. So, starting April 6, 2011, this became law. Loan officers could no longer earn more money charging higher rates. They could no longer earn more money adding prepayment penalties and things of that nature. Well, what does that mean in terms of how they're actually paid? Well, being a loan officer has always been a commission-driven environment. And a lot of people have a bad association with even the word commission. I would argue, actually, it ensures that the people that are in the business and stay in the business are doing good work. You can't just wake up tomorrow, decide to be a loan officer, and earn a lot of money. You, because you're typically paid on commission, have to get business in based on your merits, based on your reputation, based on doing a good job. And this is one of the things with the fact that there's no more variable compensation. I think that we've gotten rid of the fat cats. And the people in the industry these days, I think, are more professional. I think there's been a lot of professionalism added to the industry since these rules came into effect. So how does the commission work? If you can't earn more money charging higher rates or different terms, how does it work? Well, the main thing is that the compensation can't vary based on the terms. But it's still okay for a loan officer to earn, say, a percentage, as long as it's a flat percentage of the loan amount. They can earn a flat amount of dollars per file. So maybe there's a compensation of just a flat dollar amount per loan that they bring to the table. There are some companies that actually do offer typically a small base salary plus some sort of dollar or percentage commission on a per file basis. Well, you still want to know, how much do they earn? On average, I would say a loan officer earns about 1% of a loan amount in terms of total commission. That's probably the average. On the low end of the spectrum, maybe some of the online companies, you've got loan officers earning maybe a half of a percentage. And then there are some companies with generally higher rates where a loan officer can earn as much as 2% of the loan amount. If you have any questions about this subject or really anything else that you think I might be able to help out with, I'm more than happy to talk to you. You can give me a call or text me at this number. Thank you so much for watching.